Welcome back to International Finance. I am Andy Kim, your Dr. Finance. We are trying to finish chapter 14 of Eun, Resnick, and Chulun. Chapter 14, interest rate swap and currency swap, which is a huge market. And then very, very important for multinational corporations, CFO perspective, and global bankers perspective. There's a huge division called FICC, fixed income, currency, and commodity, and then that takes care of this kind of derivatives, right? And then this equivalency of currency swap, debt service obligations, and the discussions, it comes from in more depth in your textbook, which suggests that it is more challenging part, more in-depth, requires some more understanding, all right? But it gets back to our idea of interest rate parity relations. In the previous example, you may have thought like, those interest rates, different currencies, right? Interest rates that you have to pay for your subsidiaries, disproportionately bigger for one country as opposed to the other. And then all those differences comes from interest rate parity. And then spot rate versus forward rate differences, right? Those relation gets back again. So your final exam will cover whatever you learned in your first half of the semester naturally. The chapter 14 naturally covers interest rate parity relations, right? This is a kind of a review for your final exam as well, okay? IRP. We can assume that IRP holds between the 5% euro rate and the 7% dollar rate. All right. This is reasonable since these rates are respectively the best rates available for each counterparty who is well known in its national market. Okay. According to IRP, your forward rate should be spot rate times your domestic currency 1 plus to the power of t over your foreign currency, denominator currency, by the way, to the power of 1 plus to the power of the same time period. Okay, you just have to be consistent throughout. Your domestic currency over foreign currency. Okay, we are taking the US investors' perspective. I wish I could create some Korea-based international finance textbook in the future. Hope and pray for that, right? Please. But let's take the US perspective over here. Okay, fine. And 1 year forward rate over here as against the euro currency would be like this: spot rate times domestic currency plus 1 to the power of 1 over 1 plus foreign currency rate to the power of 1. Okay, that's 1.5286, right? That's spot rate. And then notice this is a rehashing of the assumption in the previous example. Company A would be able to borrow in their US market domestic at 7% rate, in foreign market 6%, whereas the company B, European company, they can borrow at 5% rate in domestic, and they can only borrow at 8% in their foreign market, US, right? So there is a comparative advantage for each different countries, companies, right? Let's swap it. That was the idea. So here, if you look at the cash flow patterns of this swap, right? The swap bank could borrow $60 million at 7% and use a set of 3 forward contracts to redenominate the bond as a 5% euro bond. The US dollar borrowing of 7%, right, for company A, right, it had a cash flow pattern like this: minus 60 million in day 0 because it is cash inflow, and then day 1, then 2, and 3 you are repaying the interest, right? 4.2, 4.2, and then 64.2, right? 7% rate. Okay. Now IRR is what? This is a remember the finance 101, the rate, that discount rate that makes your NPV equal to 0, right? So the cash flow pattern at 7% rate, this will be NPV 0. Okay, market is a fair game. Nobody should be having more positive NPV than not, right? So that's the market rate, 7%. Now swap bank, right? They just go through this could borrow 60 million at 7% and use a set of 3 forward contract and then to redenominate the bond and then convert it into euro, then their IRR will be 5%. Okay, how does that come about? Well, if you do the math, right, $60 million and convert it into euro at spot exchange rate, that's $40 million. That's that. And then if you convert 4.2 million US dollars 1 year from now using IRP, the interest rate parity relations, right? That's spot rate times interest rate differentials, then it's going to be 2.75 million euros. How about year 2? That's 2.70 million euros because you are doing the IRP relations 2-year period, right? Raising it to the power of 2. How about the 3rd year cash flow? That's 40.44 million euros because that's 64 million, 2.2 millions times the IRP relations over 3-year horizon. That's spot rate times interest rate differential interest rate differential over 3-year period, right? Raise it to the power of 3. Yeah. So that's 40.44. Now, that's what's happening in this chart. Now, taking it from the other side of the transactions, right? The swap bank could borrow 40 million euros at 5% rate and use a set of 3-year forward contract to redenominate the bond as a 7% dollar bond like this, okay, going to the other direction. So 40 million euro borrowing, if you convert it, that's going to be $60 million today. And then 2 million euros interest payment 1 year from now. If you do the IRP relations, right, that's going to be $3.06 million, right? And then 2 million euros, and then using the IRP relations over 2-year horizon, using that interest rate differentials, raising it to the power of 2, and then you're going to find out 3.12 million US dollars. How about the final payment, 42 million euros, and then IRP relations over 3-year periods, right? 66.67. What's the IRR that justifies this cash flow pattern? That's 7%, right? Market has to be a fair game. Now, quality spread differential, you can interpret it this way. The quality spread differential, QSD, represents the potential gains from a swap that can be shared between the counterparties and the swap bank. There is no reason to presume that the gains will be shared equally. And then the negotiation matters over there, by the way. And then QSD is calculated as a difference between the difference of the difference, right? So the difference in dollar regime, that's 1%, right? And then it's like B minus A, and then B minus A minus 1% in euro. Okay, you have to be consistent from one direction to the other, coherently, right? So 1% minus 1%, that's 2%, right? So here, you have a room for negotiation. I told you many times, you have to be a mastermind of your negotiations in the market. The communication matters a lot, right? How to communicate. Of course, your economic power and the dominant, if you're the dominant power in the market, you will get the lion's share. But most of the time, if there is no lion's share kind of guys, there's a lot of room for negotiation, and over time, how to negotiate your way up. Okay, that's not covered in this class. That's covered in your management communication class. Anyway, so variations of basic currency and interest rate swaps. The remaining part is more or less self-explanatory. All that I'm trying to say is that there are a lot of variations in this currency swap market. It's like a cookbook, right? You can just go ahead and study in your on-the-job training. You can learn it on your own, right? Currency swaps, fixed for fixed, fixed for floating, floating for floating, amortizing, all different kinds are there for you. Interest rate swaps, zero for floating, floating for floating. Those things are available in the market. I'm not going to cover those parts in our final exam or whatever, but just have some idea about it briefly. And then for a swap to be possible, QSD must exist, right? QSD must exist. It has to cover your cost of, transaction cost and then things like that. Beyond that, creativity is the only limit, right? I told you time and again. But finance guys and marketing guys, this is your playground as long as you are creative, okay? Marketing, finance goes together, okay, not separately. Risks of interest rate and currency swaps, interest rate risk is there for you. You have to worry about that. Interest rates might move against the swap bank after it has only gotten half of a swap on the books, or if it has an unhedged position. There is a basis risk as well. Basis risk may occur if the floating rates of the two counterparties are not pegged to the same index. And exchange rate risk is also there. In the example of a currency swap given earlier, the swap bank would be worse off if the pound appreciated. Right. And then risks of interest rate and currency swaps. There is a credit risk. This is the major risk faced by a swap dealer. The risk that a counterparty will default, right? Go bankrupt, essentially, on its end of the swap, okay? And then mismatch risk. It's hard to find the counterparty that wants to borrow the right amount of the money for the right amount of time. 5 years, 5 years. Oh, good luck, yes. But 5 years versus 4 years. 1 year versus 10 years. Mismatch. Sovereign risk. The risk that a country will impose exchange rate restrictions that will interfere with performance on the swap. Yeah. Right. And then the valuation of an existing swap works like this. A swap is a derivative security, so valuation can be done with reference to the value of the underlying asset. How to value a swap? Well, any swap's value is the difference in the present value of the payment stream that are incoming and outgoing. You have to take a perspective of one guy, okay? Plain vanilla fixed for floating swap get valued just like a pair of bonds, okay? Pair of bonds back and forth, back and forth. So plus minus, right? Currency swaps get valued just like two nests of currency forward contracts. Okay. Now, here's an example. A currency swap has a remaining life of 18 months. It involves, exchanging interest rate at 14% on 20 million pound for interest at 10% on $30 million once a year. Okay, it's kind of complicated or confusing because it's 3 6-month period, but here's 1 year, you say it. So the thing is, you're gonna see 12 months based calculation, and that the first payment over here will happen at 6 months, and then 18th month you're gonna see a cash flow. Now the term structure of interest rate is currently flat, okay? But why is that the case? Because the remaining life is 18 months, right? The tenor is 18 months, not the maturity itself, right? The tenor, the remaining maturity. Then the term structure of interest rate is currently flat in both the US and the UK if the swap were negotiated today. The interest rates exchanged would be 8% and 11%. All rates were quoted in annual compounding. The current exchange rate is $1.65 per pound. That is the value of the swap. what is the value of the swap in US dollars to the party paying dollars. Okay. All right. US companies perspective. Okay. So here is how it works. Timeline. You will always have to draw a timeline. Okay. Once you draw a timeline clearly, then you can the rest of it is the world is your oyster, and then and then timeline tells you whether how perceive those interpret those problems, right? So that it makes it easier to grade from the grader's perspective. Anyway, so make sure you draw your timeline in the exam, by the way, like this, right? So it is 18 months remaining, 18 months remaining tenor, right? And the thing is annual interest payment. So at the end of 18th month, there's going to be an interest and principal payment, and 12 months before there's going to be an interest payment, right? There must have been some other yearly based payments going on. We just happen to have that swap transaction, swap contract in the middle like this. So that's why the timeline looks this ugly. 6 and 18. 2.8 million pound payment, 2.8 million pound at the end. The swap contract is about the interest payment, right? Notional principal, forget about it. That's it. And then 3 months, the 3 million and 3 million US dollars payment going on, and value of the swap to the party paying US dollars, right? It works like this. So 2.8 million pound, right? 2.8 million pound discounted at go back over here, 11% pound rate. Okay, 11% pound rate. So it's just be consistent with the currency that you are using. Pound amount that you pay, well, discounted at pound rate, and the pound rate like this. At the end, don't forget to convert it into US dollars using spot exchange rate, because you are computing the present value of these things. And don't forget, this is 6 months, and then that's half a year. So that's why we are discounting at 11% and then raising it to the power of 1/2, right? That's a 6 month rate. How about 18 months? Oh my God, we're screwed. No, that's just divided by 12. That's 3/2. So that's why we raise this 1 plus 11% to the power of 3 halves, right? 3 halves, like this. So 2 different cash flow discounting at respective currencies interest rate, and later on just multiplied by spot exchange rate. That's gonna be $8.33 million, right? That's pound cash flow side of it. We are not done yet. That's one side of the story. And remember, it's a pair of bonds, cash inflow versus outflow. So this is inflow part. Outflow part is that 3 million US dollars, 3 million US dollars each time, and then 8% US rate, dollar rate, and then raising it to the power of half and 3 halves, right? 3 halves. And then this is US dollar value, so no need to worry about FX rate or whatever, just simply the number is it. That's cash outflow, $5.56 million worth. So net, which is plus minus, that's $2.77599 million, or yeah, right. That's that. Now, second swap valuation example, find the dollar value of today to the party paying US dollars of a 7-year-old swap with 3 years remaining maturity. Tenor is 3 years, right? Tenor is 3 years. The swap calls for exchanging interest only on 10 million euro at 5% for $15 million at 3% dollar rate. Okay, and then what is the coupon payment or interest payment? Not annual, but it's semi-annual, which means 6 months. Every 6 months you have to pay the interest. And the last payment was yesterday, which is just essentially just passed, right? So the soonest, the earliest payment that you have to make is 6 months from now. That's all that I'm trying to say. 6 months from now, the first cash flow happens. Okay? To make your calculation easy, right? Don't get confused. Everything is to make your computation easy. It's different from your high school experience. Your high school, I know, the purpose was to make you confused and then make it more difficult. But in college, we are making it a lot simpler so that you can get the basic concepts right. Okay? Anyway, semi-annual, right? Just happened yesterday. Today's exchange rate, spot exchange rate, $1.3 per euro, and the AAA interest rate is 2% in the US and 2.5% in the Eurozone. All right. Now that's annual rate. Annual rate. And these are coupon rate, right? Coupon rate. And then 6 month frequency. These are annual rate. So there are several things we have to worry about, okay? Coupon rate, okay? Let's go ahead over here. Second swap valuation, yeah. Find the value of the swap as the net value of a portfolio of 2 bonds. One, long a euro-denominated bond and short a dollar-denominated bond. Long, short, plus and minus, right? From US dollar payers perspective. Okay, fine. The first bond valuation is like this. Number of periods, 6. Why? Because this is 3 years period and then semi-annual coupon bond. So you have 3 times 2, which is 6. 6 periods. That's this guy. And what are we showing over here? What am I showing over here? The calculator over here. Can you see it? Yes. The cash flow function. You see on and off. Yes. And then the cash flow and all these functions that we are trying to use. That's why. The number of periods C. Okay. And then what you have to input are shown over here. This I/Y, PMT, and FV. And then you are supposed to compute the present value. So leave it untouched yet. So what do you have to punch in? I/Y, periodic interest rate, right? That has to be 2.5 divided by 2, which is 1.25. If you go back over here, pound rate was 2.5%, the discount rate in the market. Okay, that's 2.5%. But notice this is annual interest rate. So you have to divide it by 2, okay, to make it 6 month discount rate. Okay, is it euro? I'm sorry, not the British one, the euro, right? Euro one. Okay. In any case, it's cross-Atlantic from the US perspective. Anyway, so 1.25. Sorry to British people. Brexit, yes. Sorry. Anyway, so payment 250,000. Okay, because that's 5%. Rate divided by 2 and then applying it to the notional principal of 10 million euros. If you go back over here, right, 10 million euro at 5%. So divide this guy by 2. That's 2.5%. And then 10,250,000 euro is your payment. Now, how about your face value of your bond? 0, because this swap does not involve your principal payment. It's all about just a interest swap, right? Yeah, interest only swap. So 0, punch in all these numbers and then CPT, compute the punch in over here. You see this CPT value, right? CPT, can you see it? That's this guy. And then compute and present value, and you will get minus 1,436,502.48 euro as an answer. Why is it minus? As a convention of your calculator. Do we need a calculator like this in our final exam? Yeah, you need it. Yeah, but notice that their final exam is a kind of a take-home exam. You have 24 hours, so you'll have enough of time. Using your Excel spreadsheet, you can calculate this thing yourself. Fine. And then, of course, purchasing one of these will be also beneficial for your CFA exam preparation anyway. So, either way, it should be fine. Second cash flow is about your short part, right? Plus and minus. Minus part, US dollar bond. 6 periods because it's semi-annual again, and 2% discount rate divided by 2, 1%, right? And then payment 225,000 because that's 3% divided by 2 times $15 million of notional principal. That's semi-annual coupon payment. And they face value, not a future value. Face value of your bond, 0, okay? Because the swap is about interest-only swap, right? Then compute present value, 1.3-ish minus. That's your cash flow out. No. Then, yeah. One thing you should not forget about the first cash flow is that this value is euro currency value. Don't forget to convert it into US dollar, which will be 1.86-ish million US dollars worth. And notice that it has to be cash inflow. And the other one over here is cash outflow. So plus and minus will happen. So this guy minus that guy will be 563,000-ish numbers, right? Dollars value. The value of this swap is this, right? $563,000, okay, worth. Now, swap market efficiency, right? The contract is worth 560,000 the dollars, right? At the end, right? The swap market efficiency, is the swap market efficient? Is a legitimate question. Two primary reasons to use currency swap is to obtain debt financing in the swapped currency at an interest cost reduction brought about through comparative advantage each counterparty has in its national capital market to hedge long-run exchange rate risk. And then two primary reasons to use interest rate swap is to better match maturities of assets and liabilities and to obtain a cost savings via quality spread differentials or QSD, right? In an efficient capital market, without barriers to capital market flows, the cost savings argument through QSD would imply that an arbitrage opportunity exists, okay? QSD diminishes over time accordingly if this is an arbitrage opportunity, and the swap market would shrink down over time, swap market size, okay? But swap market size grew rapidly over time, okay? Why is that the case? Is the market getting less efficient with the swap market? The answer is no, okay? Obviously, information technology improves, and then the more market participants get in there, and the swap market gets more liquid. By nature, by economics mechanism, the markets should get more efficient. But why is this swap market size getting expanded more and more? That has to do with our initial assumption in the market efficiency, okay? In the beginning of this class, the first video, right? Chapter 14, I told you about this before. It's all about investor recognition, right? Traditional neoclassical economics assume that we are fully aware of all the investment opportunities. The investors in the market are fully aware of all the investment opportunities. complete information assumption. Okay, complete information. But that complete information assumption broke down seriously. Okay, it breaks down seriously in swap market. Not all of the companies you are aware of, only a small subset of group of companies you're aware of. And then from the CFO's perspective, like you are the CFO of Celtrion, you are only aware of a small group of financial products available in the whole market. You are not aware of thousands of different or millions of different possible financial instruments or borrowing schemes that you use that you can use in all different countries, in 200 different countries, right? The world is big, and then the financial products are various, right? So the CFOs are not aware of the full set of the investment tools, and then the investors in the market may not be aware of you. Who are you, right? It gets back to our Jahangir Khan versus Sai kind of country by country differentials, right? Market by market differentials, right? So the information is incomplete in the market. So we cannot say for sure about the market efficiency itself, but incomplete information market is a problem, and investors have information about only a limited number of firms. Not efficiency, but incompleteness is a problem. And then the swap market resolves the situation of incomplete market and make it more complete, right? That's the contribution these swap traders are making. Swap offers market completeness, and that has accounted for their existence and growth. And swap assists in tailoring financing to the type desired by a particular borrower, since not all types of debt instruments are available to all types of borrowers, but both counterparties can benefit, as well as the swap dealer through financing that is more suitable for their market maturity, asset maturity structures. So does the swap market, swap traders make the market more efficient? Yes, they do. Okay, they make the market more efficient to the extent that both parties get to know each other, and then the other potential candidates get to know each other more, right? So that the swap traders make the information more complete, and then helps the market to become more efficient over time. Still, the market is incomplete everywhere. Globally, it's incomplete, so that there is a huge opportunity for swap going on. So that's why the swap market expands, right? All right, so that's that. Now, the summary is self-explanatory, so go ahead and read it. Now, thanks for watching it. Like and subscribe. 좋아요, 구독은 사랑입니다. In Korean word, we say it means I love you, right? Please like and subscribe if you like my lectures, and then hope to see you in the next class. All right, thank you. Bye-bye.